That was somewhere between 1% and 6%. So given the very low level of claims combined with the high level of sales of the product, we believed we need to examine this issue further.
We've spoken to one permanent TSB customer who took out a home improvement loan in 1999. He was told he could only get the money if he also took out a payment protection policy. He got into difficulty repaying the loan and it was restructured. He now owed just under €17,000 and his payment protection premium increased to just over €1,800. He was extremely unhappy with the cost of this insurance and continually questioned how it was made up. Eventually, having threatened to take a case under the Data Protection Act, he was given a breakdown of the premium. To his astonishment, he discovered that permanent TSB had cleared €880 in commission from the policy it had forced him to take out. That worked out at over 49%, almost 5 times the administration fee charged by the broker and considerably more than the 40% that went to the insurance companies who actually carried the risk. He threatened to expose this in the media and was refunded the entire premium cost. In fact, this customer got a bargain. Permanent TSB have confirmed to Primetime that their regular commission on payment protection policies is a cool 50.3%. Permanent TSB declined to take part in this programme. In a statement they said, "It is our understanding that the level of commission received in respect of this product is in line with commission payments to banks across the industry." The statement added that in no instance would the bank agree to a settlement of a complaint such as this on the basis that the customer would not go to the media.
Well, there are 2 shocking things about that. The first is that, as you say, the commission and also the administration fee is over half of the premium that the person is paying. And the second shocking thing for the 21st century is that consumers don't know this because there's a complete lack of transparency and it requires a journalistic investigation to discover this. Why can't people be told what they're paying for? And it's up to them then to decide whether it is value for money. But I think it would be extremely difficult to show that over 50% going in commission overheads is value for money in this instance.
Given the level of work that's involved in actually selling the products and maintaining them, it does seem like an extraordinarily high level of commission to be charged. What does that mean in terms of the cost they're paying? And what it means in terms of the cost they're paying is that they're paying somewhere between €1,000 and €2,000 on a loan of only €10,000 over 5 years. That seems a very expensive product.
But that's not all. That cost can rise significantly because in all cases we surveyed, the banks actually loan customers the money to buy these policies.
We think it was a bad day for the consumer that the credit industry began to loan the consumer the money to buy the payment protection and to loan it to them at the same interest rate as the loan. We have seen interest rates of 30–40%. People paying on loan and on loan protection and causing people great difficulty.
So how come so many of us opt to take out this very expensive policy? The reason may lie with the aggressive sales techniques employed by the banks.
Loan protection as well, you probably would like to go with that, wouldn't you?
Anyway.
For staff on the front line, on a daily basis they will be given targets on specific products. They're not asked about the efficacy of those products, they're focused on the actual target itself and have to review sometimes on a weekly basis of what they've done to achieve those targets. So there's enormous pressure on staff.
At the end of the day, this can lead to policies being missold to people who are ineligible to claim on them, and far from protecting people from debt, can actually be the cause of it.
Yeah, well, when people are taking out a loan and payment protection is offered to them in the same breath and in the same documentation as a loan, the propensity for the client or the customer to take out the payment protection insurance is quite enormous because they want to secure peace of mind.
Well, it's very expensive peace of mind, but the people for whom it buys the best peace of mind is actually the banks themselves, because this provides the banks really mostly with the security of not having to pursue you through the courts if, for example, you can't make your payments.
The new Consumer Protection Code, which comes into force in July, will require the industry to spell out to customers just how much these policies ultimately cost and to ensure that they suit customers' needs. But so far, the regulator hasn't moved to force banks to reveal their commission.
We're looking at the Commission's consultation document in conjunction with the codes. So I can't tell you definitively that that's what will be in place when the code is in place. What I can tell you definitively is that the total charge has to be made clear to the customer. That would include the commission charge.
At the end of the day, we believe it's going to be a short-sightedness on behalf of banks, that if they do exploit customers and customers become more aware of their needs, that long term they will move their business elsewhere, and that will be very serious implications for the industry as well as for our members.
In reporting, well, we have to point out that the Irish Bankers Federation were asked to come on our programme tonight, but they declined our invitation. But we're very glad to be joined now by Deputy Sean Fleming, who's the chairman of the Joint Oireachtas Committee on Finance. Sean Fleming, you've had reason to look at various different accusations of overcharging and sharp practice by the banks. Were you surprised by anything you've just seen in that report?
Yes, I'm actually shocked at the level of commission, because I had presumed, and I think most people had presumed, that if you take out an insurance policy for 3 or 4 years, you do pay a hefty commission on your payments in the first year. It was now clear from looking at that every month over the 48 months or 60 months of the agreement, over half of what you pay every single month is going straight to the bottom line profits of the bank, and that's absolutely excessive.
So how would you characterise that rate of commission? What the banks do to get you to buy that protection, for example?
Well, the commission is over the top. It's certainly, I believe, some of these policies have been missold in the first place, because they're offering policies to people, and in many cases it's unsuitable. Public servants are taking out policies where the redundancy clause is not really an option. Self-employed people are being sold these policies as well, and people find that when they go to claim, the policies don't cover what they thought they would claim. So I think, I would go so far as to say it is almost a swindle by the bank, because if Backstreet Hucksters did this, something worth 400, and that's all it costs, and they were selling it to you for 1,000. And the public thought the banks were improving their relationships with their customers, but clearly there's a lot going on under the surface that hasn't come out yet.
But how come? And we've heard so much about this new regime of scrutiny